Best day of the week to buy stocks. A common question among investors is, what is the best day of the week to buy stocks? While there are theories and historical trends that suggest certain days might be more favorable, the truth is that there's no definitive answer. The stock market is a complex ecosystem influenced by numerous factors, including economic indicators, company-specific news, and global events. One popular belief is that Mondays are the best day to buy stocks, often referred to as the Monday effect. This theory posits that stock prices tend to decline on Mondays due to negative news released over the weekend. However, this trend has become less pronounced in recent years, as investors have become more accustomed to digesting and reacting to news quickly. Another theory suggests that Fridays are a good time to buy, as investors may be more willing to sell ahead of a long weekend, potentially driving down prices. However, this can also lead to a rebound on Monday as investors buy back into the market. While these theories offer potential insights, it's important to remember that they are based on historical data and may not hold true in every market condition. The stock market is dynamic and can be influenced by unexpected events that can disrupt any perceived patterns. Rather than focusing on the day of the week, investors should prioritize fundamental analysis. This involves evaluating a company's financial health, competitive position, and growth prospects. By understanding the underlying value of a company, investors can make informed decisions about when to buy or sell, regardless of the day of the week. It's also crucial to consider your investment goals and risk tolerance. If you're a long-term investor, focusing on the day of the week may be less important than investing in quality companies with strong growth potential. On the other hand, short-term traders may be more concerned with timing their trades to capitalize on short-term price fluctuations. Diversification is another essential strategy for managing risk. By investing in a variety of assets, investors can reduce their exposure to any single stock or sector. This can help mitigate the impact of negative market events and improve overall portfolio performance. Dollar-cost averaging is another technique that can be beneficial. This involves investing a fixed amount of money in a particular asset at regular intervals, regardless of the price. This strategy can help investors average down the cost of their investment over time, reducing the impact of market volatility. In conclusion, while there may be historical trends that suggest certain days of the week might be more favorable for buying stocks, these patterns are not guaranteed and can be influenced by a variety of factors.